Welcome back to our Red Follower International Tax Update. Today we're looking at China and a tax measure that may sound technical at first, but actually tells us quite a lot about how China is using corporate taxation to support strategic industries. The measure concerns semiconductor businesses and advanced industrial machine tool companies, and the key number is 5 years. China is allowing qualifying companies to spread corporate income arising from certain non-monetary asset exchanges over a period of up to 5 years, rather than paying corporate income tax on the entire gain immediately. The rules were introduced by announcement number 23 of 2026, issued on the 31st of July by 4 authorities: the Ministry of Finance, the State Taxation Administration, the National Development and Reform Commission, and the Ministry of Industry and Information Technology. The measure applies to qualifying transactions taking place from the 1st of January 2026 through the 31st of December 2028. But if a company starts a 5-year deferral before the end of 2028, it can continue using the installment arrangement until the 5-year period is completed. So what exactly is the benefit? Suppose a qualifying semiconductor company owns an asset with a tax basis of 20 million renminbi. The fair value of that asset has increased to 100 million. Instead of selling the asset for cash, the company exchanges it for another non-monetary asset worth 100 million. Ignoring transaction costs, the exchange produces an 80 million renminbi taxable gain. Under ordinary taxation, recognizing that entire gain immediately could create a major cash flow problem. The company has received another asset, but it has not received 100 million renminbi in cash. Under the new regime, that 80 million gain can instead be recognized evenly over a period of up to 5 years. If the maximum period is used, the company would recognize 16 million renminbi each year rather than 80 million in the first year. That distinction is important. This is not a tax exemption. The gain is still taxable. China is changing the timing of taxation. Economically, you can think of this as the government effectively providing an interest-free financing benefit on the corporate tax associated with the exchange. The company keeps the cash that would otherwise have been needed to pay the tax immediately and can continue using that liquidity in the business. There is also an important detail that is easy to miss from the headline. The rule is not actually limited to equipment swaps. The legislation refers more broadly to non-monetary assets. Monetary assets include things such as cash, bank deposits, receivables, bills receivable, and certain bonds. Assets outside that monetary category may qualify as non-monetary assets. So the concept is broader than simply exchanging one production machine for another. The transaction must, however, involve one non-monetary asset being exchanged for another non-monetary asset. If a transaction contains both monetary and non-monetary consideration, the special treatment applies only to the qualifying non-monetary part. Any income relating to cash or other monetary consideration remains subject to the ordinary recognition rules. Now let us look at the other side of the rule. Who actually qualifies? The answer is considerably narrower than saying that every Chinese technology company, every chip maker, or every company using industrial machinery qualifies. Announcement number 23 refers back to an earlier regime, announcement number 44 of 2023. For integrated circuits, the qualifying population covers nationally encouraged businesses in several parts of the semiconductor value chain. These include integrated circuit production, certain important integrated circuit design enterprises, semiconductor equipment manufacturers, semiconductor materials businesses, packaging companies, and testing companies. In other words, this can cover considerably more than a conventional chip fabrication plant. It potentially reaches design, specialized manufacturing equipment, semiconductor materials, packaging, and testing. But the businesses must satisfy the specific industrial policy qualification rules. For categories managed through official lists, the National Development and Reform Commission and the Ministry of Industry and Information Technology provide the relevant enterprise lists to the finance and taxation authorities. So simply describing yourself as a semiconductor company is not enough. The second category is industrial machine tool enterprises. Again, this does not mean every company that owns or operates a machine tool. The earlier announcement number 44 refers to enterprises producing and selling products meeting the standards for advanced industrial machine tools. The qualification framework and enterprise lists are determined by the relevant Chinese industrial and economic authorities. This tells us something important about the design of the measure. China has not introduced a general 5-year tax deferral for asset exchanges across the entire economy. It has selected two strategically important industrial groups and connected the tax benefit to an existing qualification system. There is another interesting feature. The counterparty to the transaction does not necessarily need to be a qualifying semiconductor or machine tool company. If a qualifying semiconductor enterprise exchanges a non-monetary asset with an ordinary company, the qualifying semiconductor enterprise can use the special deferral, while the ordinary company follows the normal tax rules. If both parties are qualifying enterprises, both may potentially benefit. So the incentive attaches primarily to the qualifying taxpayer rather than requiring the entire transaction to take place only within the protected industrial sectors. The treatment of the replacement asset is also worth noticing. China is not simply carrying the old tax basis into the new asset. The asset received in the exchange generally receives a tax basis equal to its fair value plus the relevant taxes and fees. At the same time, the gain realized on the old asset is recognized gradually. Conceptually, this is therefore different from a classic rollover regime under which the historic low basis simply moves into the replacement asset and the gain remains deferred until a later disposal. Here, the gain is calculated, the new asset receives a fair value-based tax basis, but payment of the tax attributable to that gain is effectively stretched over a maximum of 5 years. There are also clear anti-abuse and continuity conditions. If the company disposes of the replacement asset during the 5-year deferral period, the remaining deferred gain must be recognized immediately in the year of disposal. The same principle applies if the company is deregistered before the 5-year period has finished. The outstanding deferred amount becomes taxable as part of the final corporate income tax settlement. Losses also receive different treatment. The favorable 5-year spreading mechanism applies to gains, but losses from non-monetary asset exchanges cannot be spread over time and remain subject to the normal recognition rules. So why has China introduced this measure? The most immediate economic explanation is liquidity. A non-monetary exchange can create taxable income without generating cash. If a company exchanges an appreciated production asset for another productive asset, an immediate corporate tax charge can make the transaction considerably more expensive, even though the company has received no cash proceeds. The 5-year mechanism reduces that mismatch between accounting or tax recognition of the gain and the company's actual cash position. But there is also a broader industrial policy dimension. The earlier qualification rules expressly describe their objective as encouraging research and innovation and promoting high-quality development of the integrated circuit and industrial machine tool industries. Those same categories have now been used for this asset exchange incentive. That makes the choice of sectors significant. Semiconductors require enormous continuing investment in production technology, specialized equipment, materials, and testing infrastructure. Advanced machine tools are themselves essential inputs into sophisticated manufacturing. The new measure, therefore, reduces the tax friction associated with companies exchanging, replacing, and reorganizing productive assets in precisely those industries where technological upgrading and capital investment are particularly important. And the acceleration rule reinforces that interpretation. The company receives the timing benefit while it continues holding the replacement asset. If it sells that asset, the remaining deferral ends. So the structure encourages continued productive deployment of capital rather than simply allowing businesses to convert appreciated assets into cash while postponing the tax. There is one final practical point. China already has other tax regimes dealing with non-monetary asset investment and qualifying corporate restructurings. Where a transaction potentially falls under those existing rules as well as the new regime, the company may need to choose which tax framework to apply. Once that choice is made for the transaction, it cannot simply be changed afterwards. The takeaway is therefore more interesting than the headline suggests. China is not simply giving chip makers a tax break on new machinery. It is creating a targeted cash flow incentive for qualifying semiconductor and advanced machine tool enterprises that exchange non-monetary assets. The taxable gain remains, but instead of collecting the corporate income tax immediately, China allows the gain to be spread over as much as 5 years. For businesses undertaking capital-intensive technological upgrading, that timing difference can be economically significant. And, from a policy perspective, the message is equally clear. China is using the timing of corporate taxation as another instrument to channel liquidity towards strategically selected industries, encourage continued investment in productive assets, and reduce the tax cost of industrial modernization. That is the development to watch. See you next time.